A first home savings account, an FHSA, is a registered plan which allows you, if you are a first-time home buyer, to save to buy or build a qualifying first home tax-free, up to certain limits. Here is the FHSA at a glance. The highlights up front. Contribution rules. The annual limit is $8,000. Unused room can carry forward, generally up to $8,000. The lifetime limit is $40,000 during your maximum participation period. Who can open? You generally must be a resident of Canada, at least 18 years old, and a first-time home buyer under the FHSA rules. In some provinces or territories, you may need to be 19 to enter into the FHSA contract with the issuer. Tax deduction. Eligible contributions are generally tax deductible. Transfers into your FHSA from your RRSP are not deductible, but those transfers still use FHSA participation room. Key advantages. Contributions can reduce your tax. Growth can be tax-free. A qualifying withdrawal to buy or build a first home can be tax-free and does not need to be repaid. If you never buy, you can generally transfer the balance tax deferred to an RRSP or RIF in your name. Limitations. The account does not last forever. Your maximum participation period ends on December 31st of the year of the earliest of the 15th anniversary of opening, the year you turn 71, or the year after your first qualifying withdrawal. Non-qualifying withdrawals are taxable. Living in a home owned by your spouse or common law partner can block eligibility to open. Watch for traps. Track your room so you do not overcontribute. Excess amounts face a tax of 1% per month. Use direct transfers if you want tax-deferred treatment. File Schedule 15 the year you open, and close the account before the participation period ends. This video is based on Canada Revenue Agency guidance on canada.ca. The rest of the video walks through the rules in more detail. First, opening your FHSA. To open an FHSA, you must be a qualifying individual by meeting all of the conditions when you open your account. If you do not meet all of the conditions, you are not a qualifying individual and cannot open an FHSA. In plain terms, you generally need to be a resident of Canada, at least the age of majority where you live, and a first-time home buyer under the FHSA rules. Important. If you currently live with your spouse or common law partner in a home that they own, you are generally not considered a first-time home buyer for opening an FHSA. You can open one or more FHSAs through an FHSA issuer, such as a bank, credit union, or a trust or insurance company. Contact your issuer and provide the information they need to register your FHSA, including your social insurance number, your date of birth, and any supporting documents they need to certify that you are a qualifying individual. If you provide information to the issuer and it is later determined that the information was incorrect, the registration of your FHSA may be revoked as far back as the date it was opened. After revocation, contributions are not tax deductible. RRSP transfers are treated as RRSP withdrawals, and income earned is not tax-free. You must fill out Schedule 15, FHSA contributions, transfers, and activities when you file your income tax and benefit return for the year you opened your first FHSA, even if you did not contribute or transfer anything that year. Next, participating in your FHSAs, how much you can put in. Generally, your FHSA participation room for the year is the maximum amount that you may contribute or transfer to your FHSAs in the year without creating an excess FHSA amount. Your FHSA participation room in the year you open your first FHSA is $8,000. That room applies across all of the FHSAs you open. You can open more than one FHSA, but the total of contributions and RRSP transfers to all of them cannot be more than your participation room for the year. Only the holder of the FHSA can participate directly in their own FHSAs, and only the holder can claim the FHSA contributions as a tax deduction. Generally, any income earned in the FHSA for example, investment income and capital gains, will not count towards your FHSA participation room. Unused participation room can carry forward, but only up to $8,000. In practice, you generally cannot catch up more than one extra year of room at a time, often up to $16,000 in a year if you had a full unused prior year. Over your lifetime, contributions and transfers are also constrained by a $40,000 lifetime limit. Transfers into your FHSAs. Generally, you can transfer property between your FHSAs or from your RRSPs to your FHSAs without immediate tax consequences, as long as it is a direct transfer. You must not withdraw the property yourself and contribute it to another plan. That would not be a direct transfer, and the withdrawal can be taxable. To complete a direct transfer from your RRSP to your FHSA, fill out Form RC-720 and give it to your financial institution. The transfer reduces your unused FHSA participation room. It does not restore your unused RRSP deduction room. And while FHSA contributions can be deductible, transfers from your RRSPs to your FHSAs are not deductible. You may be able to transfer from a spousal or common law partner RRSP, but special rules apply if your spouse or common law partner contributed in the same year or the 2 previous calendar years. Get this checked before you transfer. Withdrawals and transfers out of your FHSAs. A withdrawal from an FHSA is not required to be included in your income if it is a qualifying withdrawal, a designated withdrawal, or an amount otherwise included in your income. Other withdrawals are taxable. If you meet all of the qualifying withdrawal conditions, you can withdraw all of the property from your FHSAs tax-free in a single withdrawal or a series of withdrawals. There is no minimum holding period. You do not need to repay qualifying withdrawals. A qualifying home is a housing unit located in Canada, including existing homes and homes being constructed. Before the withdrawal, you generally need an agreement in place to buy or build, and you must meet all first-time homebuyer and residency conditions at the time of the withdrawal. You must begin to use the home as your principal place of residence, or intend to use it as your principal place of residence no later than 1 year after acquiring it. You can withdraw amounts from your RRSPs under the Home Buyer's Plan and make a qualifying withdrawal from your FHSAs for the same qualifying home, as long as you meet all of the conditions at the time of each withdrawal. You cannot cancel a qualifying FHSA withdrawal once it has been made. Generally, you can transfer property out of your FHSAs without immediate tax consequences if it is a direct transfer to your RRSP or RIF to another of your FHSAs or a designated transfer. Use Form RC-721 or your institution's equivalent documents. A proper direct transfer to your RRSP or RIF generally does not use your unused RRSP deduction room. Again, do not withdraw the money yourself and put it into another account if you want a tax-deferred transfer. Tax deductions for FHSA contributions. Contributions that you make to your FHSAs are generally deductible on your income tax and benefit return for the year of the contribution or a future year, similar to RRSP contributions. It is important to note that transfers from your RRSPs to your FHSAs are not deductible. Unlike RRSPs, contributions you make to your FHSAs during the first 60 days of the year cannot be deducted on your return for the previous year. The contribution period for FHSAs is the calendar year. Over your lifetime, the most you can deduct from your income as an FHSA deduction is $40,000. Transfers from your RRSPs reduce the amount that can be deducted over your lifetime. What happens if you contribute or transfer too much? Generally, you have to pay a tax of 1% per month on the highest excess FHSA amount in that month. You continue to pay until the excess is eliminated. If you have an excess FHSA amount, you must file Form RC-728, First Home Savings Account Return, and Form RC-728 Schedule A, Excess FHSA Amounts, to report the excess and determine the tax payable. To make a designated withdrawal or designated transfer, Fill out Form RC 727 and give it to your FHSA issuer. A designated amount is limited to the excess at the time of the designation. If you make a designated withdrawal or designated transfer correctly, that amount is generally not required to be included as income. A designated transfer will not impact your unused RSP deduction room. A qualifying withdrawal does not reduce or eliminate an excess FHSA amount. Before you make a qualifying withdrawal, make sure you do not have an excess. Closing your FHSAs. Your maximum participation period begins when you first open an FHSA and ends at the end of the year following the year in which the earliest of these occurs. The 14th anniversary of opening your first FHSA, the year you attain age 70, or your first qualifying withdrawal. In order to avoid unintended tax consequences, you should close all of your FHSAs before your maximum participation period ends. If you still have property in the account, you can generally directly transfer it on a tax-deferred basis to your RRSP or RIF, or take a taxable withdrawal. If property remains after your maximum participation period ends, the accounts lose their status as FHSAs. You must include the fair market value of the property as of the end of December 31st of that year as income. To close your FHSA, contact your issuer and follow their instructions. Your issuer reports the closure to the CRA. You do not need to send confirmation to the CRA unless they ask. Life events can change how an FHSA works. Marriage or common law breakdown, becoming a non-resident of Canada, or death of the holder. The CRA has specific rules for each situation, including successor holder and beneficiary treatment on death. If one of these applies to you, read the Life Events page on canada.ca or speak with a qualified advisor before you move money. Investments in your FHSAs. Issuers may offer a depository FHSA, a trusteed FHSA, or an insured FHSA. Qualified investments can include money, term deposits, GICs, bonds, mutual funds, and securities listed on a designated stock exchange, depending on the type of account. You can set up a self-directed FHSA if you prefer to build and manage your own portfolio of qualified investments. Taxes can apply if the account holds non-qualified investments. Confirm what your issuer allows. Reporting FHSA activities on your income tax and benefit return. Your FHSA issuer will give you a T4 FHSA slip, First Home Savings Account statement, showing contributions, transfers, withdrawals, and other amounts for the year. Use Schedule 15 to report FHSA contributions, transfers, and activities. Complete it for the year you opened your first FHSA, even if there was no contribution activity. Among other amounts, qualifying withdrawals appear in Box 20, taxable withdrawals in Box 22, and transfers from RRSPs in Box 32. Always match your return to the slip. If you have FHSA taxes payable, for example, tax on an excess amount, file the required forms and pay by the deadline. File Form RC 728 when you have excess amounts. Keep your records and respond to CRA notices, assessments, and reassessments. The CRA also publishes tax-free FHSA estimators, definitions, and FHSA statistics on canada.ca. Use the estimators only as estimates. Your actual room and deduction depend on your own facts and filings. Key takeaways. 1. Confirm you are a qualifying individual before you open. 2. Opening starts your participation room. 3. Track annual and lifetime limits so you do not create an excess. 4. Use direct transfers if you want tax-deferred treatment. 5. File Schedule 15. 6. Close the account before your maximum participation period ends. This video summarizes public guidance from the Canada Revenue Agency. It is not tax advice. Rules depend on your situation. When in doubt, read the FHSA pages on canada.ca or speak with a qualified tax professional. For the full rules, go to the Canada Revenue Agency's First Home Savings Account pages on canada.ca.